much more to what we see in fixed income. Ira Jersey joins us. He's Chief U.S. Interest Rate Strategist at Bloomberg Intelligence. Ira, your thoughts on a refunding? Clearly, the equity markets like it.
Yeah, I think people were hedged for maybe even more long end issuance than the Treasury market delivered. And I heard you just talking to Mr. Carpenter there, talking about the fact that the Treasury Department kind of is looking for where they can get the best demand for the product that they're selling, and by doing a little bit less in the long end and a little bit more in the front end, you've seen a pretty decent rally as a knee-jerk reaction to this announcement.
It's a knee-jerk reaction, but isn't this just policy prescribed over the decades of saying we're going to be measured, cautious, and when in doubt, stay with short-term paper?
Well, the Treasury Department has what they want to be. They want to be very consistent in how they operate, and they're always going to adjust issuance based on market conditions, based on demand. So keep in mind, like something that Lisa said early on, I have to push back on a little bit. The Treasury Department did increase its long end issuance quite substantially when interest rates were extremely low a few years ago, with the average maturity of the debt of the public going from under 5 years all the way up to over 7 years. That's come down a little bit as they've been increasing a lot of T-bill offerings have obviously come up quite a lot since the debt ceiling was raised back in June. So I think now they're kind of calibrating even again, saying, okay, it's okay if we reduce the average maturity of the portfolio a little bit because there is a demand preference for short paper like 2-year paper, 3-year paper when interest rates are above 5% there, and there's decent demand, whereas in the long end where there's less demand, we just won't raise as much. But they still raise, right? They still are issuing more long-term debt. It's just at a slower pace than they were before.
Should we have a French 50-year bond equivalent? Or dare I say, with my losses, Ira Jersey, should we have a 100-year Austrian bond equivalent?
So I was a little bit surprised back when they announced that they were going to do the 20-year that they didn't also do a 50-year, because I think that the 50-year meets the needs of certain investor types. I think that one of the big fears was twofold for the Treasury Department. One is they didn't think they could do it enough in size that it would really matter, whereas they could do just more 30-year bonds or 10-year bonds and issue more of those. And the second is that they were worried that liquidity would be very poor, because they know that whatever they did sell would probably just be put away at insurance companies and some pension funds, and you'd never see the light of day. So there might be a bit of a liquidity issue with that. So do I think that it could work? Yes, but it has to be structured right.
I've got a recollection, Ira Jersey, of the Tennessee accent of John Templeton. And Sir John would say, I predict there'll be a shortage of bonds. And I would say, through the recent years, there's been a feeling of a shortage of bonds, price up, yield incredibly low. Is there a shortage of bonds right now?
I don't think so, and primarily because there was a shortage of bonds when you had global savings wasn't exceptionally high. And with global savings now being eaten up by inflation and by less workers in the workforce, because even though there's now a shortage of workers, that there probably is. I don't want to say that there's too many bonds outstanding right now, but certainly supply demand is somewhat more imbalanced now than it was. You also now, of course, don't have over the last 20 years central banks in the market at the extreme levels that they were before. Even the Bank of Japan is starting to pull back quite a lot on its bond purchases. So as you get all the supply-demand dynamics shifting, you're going to have probably somewhat structurally higher yields in general, regardless of how many bonds you actually have outstanding.